Alright, so let's pick up where we left off. We're first going to cover the straight line method only in this particular video. Okay, so method number one, the straight line method, how do we proceed? As I mentioned earlier, you all have to pick up some data in order to calculate some things in this particular chapter. So for the straight line method, you first need to grab the historical cost number. Okay, so whatever it cost us to get the asset ready for its intended use on land improvements, on buildings, or on equipment. Again, we're not applying depreciation to land. So we're going to grab the $13,000 number and use that for historical cost, okay? We also need to grab the salvage value. The expected salvage value for our particular asset here is the $1,000. So we're going to grab those two numbers because we've got to calculate what is called depreciable cost. Okay, so this is another term with the word cost in it. Okay, so historical cost is one thing, depreciable cost is something else. Okay, so we are going to calculate depreciable cost by taking the historical cost and subtracting salvage value from it to get depreciable cost. So on this particular one, historical cost of $13,000 minus $1,000 in salvage value equals depreciable cost of $12,000. We're actually going to use that same formula for depreciable cost when we do the units of activity method, which I will do in a separate video. The other thing that we need for the straight line method, while we're on this slide though, is this 5 years in useful life. Because what we're going to do is take that depreciable cost of $12,000 and we're going to spread it across the 5 years of useful life. Okay, so we're choosing a method that's going to be ratably spreading the assets cost, or a lot of the assets cost, not necessarily all of it because of the salvage value, over the 5-year useful life. Alright, so if we do the first step, historical cost of $13,000 minus salvage value of $1,000, we get depreciable cost of $12,000. Step number one, calculate depreciable cost. And then step number two for the straight line method is you just take that depreciable cost number that you just calculated and you divide it by the useful life in years. And when we do that, on this particular asset, we were told its useful life was 5 years. If we divide that into the depreciable cost, we get $2,400 that's going to be spread across a year. Okay, so $2,400 for the year is going to go to depreciation expense. Likewise, $2,400 is also for the year going to go to the accumulated depreciation account. Because as I mentioned in a prior video, the journal entry is going to be increase to depreciation expense so that we can get it to show up on the income statement, and then an increase to that contra asset account, accumulated depreciation hyphen, and for this particular asset, it's a truck, so that's equipment, not a building, not land improvement, but equipment. We would put that $2,400 in that contra asset account. So if we were to go and look at this in a chart view, which my accounting majors are quite often tasked with building these in an Excel spreadsheet. On this particular one, you guys can see that we have columns here. Our depreciable cost is what? It's not the historical cost, $13,000, but instead it's that historical cost minus salvage value. So for the purchase date, January 1, 2017, we would calculate depreciable cost as $12,000. And then you notice here that Wiley's giving us a column for a rate. Well, we just divided this particular 12,000 depreciable cost by 5 years. And if we're trying to calculate a rate or a percentage to fill out this chart, what we would do is say, what is 1 year divided by the 5 years total? So what is 1 year's worth out of the 5 years worth? Well, that would be a rate of 20%. I want to make sure that you get how to calculate this rate right here. What if this was a 4-year asset? What would the rate be? 1 year divided by 4 would be 25% rate. What if this was a 10-year asset? 1 year divided by 10 years would be 10%. What if it was a 20-year? 1 year over 20 years would be 5% rate. Okay, so if you had to calculate the rate, you just take 1 year and divide it by the number of years useful life. This chart is showing you that you could either divide the asset by the number of years to get the annual expense, or you could take that depreciable cost and multiply it times the rate to get the annual expense. Okay, so we saw a moment ago 12,000 depreciable cost divided by 5 years equals 2,400 in annual expense. Well, if you take 12,000 and multiply it times a rate of 20% instead, you will also get 2,400. Again, the journal entry is going to increase depreciation expense 2,400 and then increase the account accumulated depreciation equipment 2,400. If we wanted to calculate book value, which we've discussed earlier in the semester, is like saying equipment, comma net, what would your book value be here at the end of year 1? Well, what's the formula for book value? It is historical cost, 13,000, what is sitting on that balance sheet for the asset equipment, what we paid for it, minus the contra account, accumulated depreciation equipment, which now has the 2,400 in it. Therefore, our book value at the end of year 1 is 10,600. For year 2, 2018, we would go through the same process. It's still going to be the $12,000 for the depreciable cost divided by 5 years or multiplied times 0.2, which is 1/5 of the time, and we would get 2,400 again. Our journal entry again would be to increase depreciation expense and increase accumulated depreciation equipment for 2,400. Therefore, what would the balance be in the accumulated depreciation account after that journal entry? It would be 4,800. And if we needed to calculate equipment common net or book value, we would do the same thing we've been talking about all semester long. Historical cost, 13,000, minus the accumulated depreciation up to the date we're talking about, which it's now sitting at 4,800. It's this 2,400 plus another 2,400 to get us up to 4,800. Therefore, our book value at the end of year 2 would be 8,200. For year 3, we would do the same thing, you guys. 12,000 divided by 5 years, or 12,000 times 0.2, and we would again get 2,400. Increase depreciation expense, 2,400, and increase accumulated depreciation by another 2,400. So now on the balance sheet for year 3, this contra account now has 7,200 total in it, because this is an contra asset account. This balance just keeps changing on the balance sheet. The expense account on the income statement for this year and this year and this year was 2,400 for each year. But this account gets accumulated over time. And you can see that it keeps getting larger by the $2,400 journal entry. So what would our book value be at the end of year 3? Again, it's just historical cost, the equipment account on the balance sheet, 13,000, minus the accumulated depreciation hyphen equipment, or the contra account. So our equipment common net number, or book value, at the end of year 3, after that journal entry, would be sitting at 5,800. Doing it again for the 4th year, we would have another journal entry. Increase depreciation expense, 2,400. Increase the accumulated depreciation hyphen equipment yet again by another 2,400. And we would be sitting at 9,600 in that account. Our book value would be historical cost of 13,000 minus that 9,600, leaves us with a book value of 3,400. And then finally, the 5th year of use. Again, 12,000 divided by 5, or 12,000 times 0.2, would give us again 2,400 in depreciation expense, and an additional 2,400 to that accumulated depreciation hyphen equipment account. 9,600 from last year's balance plus another 2,400 from our journal entry would leave us sitting at 12,000. Our book value then at the end of year 5 would still be calculated the same. Historical cost, 13,000 minus the 12,000 in accumulated depreciation gives us equipment common net, or book value, of 1,000. Now, if you guys will sit here and look at this and think about what we have just done, look at what number we have sitting in accumulated depreciation. Is this not what we calculated as depreciable cost? We have now taken the depreciable cost of 12,000 and spread it evenly, straight line method, across 5 years. Each year received the same because we bought it on January 1 of the first year. And look what happened with our book value. Our book value is sitting at the salvage value that we calculated. So historical cost of 13,000 minus the accumulated depreciation, which at the end of year 5 is also equal to our depreciable cost, has left us sitting at 1,000. Now, something I want to say here about this straight line method, because it's so easy and very, very straightforward, that's why a lot of people use it. I want you to make sure that you understand that what we are trying to do here is just expense the asset out over its useful life. We are in no way, shape, or form trying to say that at the end of year 1, if we were to take this truck and try to trade it in, that we would get $10,600 for it at trade-in. At the end of year 2, $8,200. That is not what we're doing here. We are not trying to match some NADA Blue Book or NADA Black Book value for trade-in used at some dealership somewhere. okay? We are instead applying a methodical calculation in order to expense out the asset over its useful life. All right, if you have particular questions about this, I definitely do want you guys to use the discussion board, and I will try to answer any questions there. Don't forget that Wiley also has videos about how to do these calculations as well, so make use of those resources. I will do a separate video for the declining balance method for this chapter, and I will also do another separate video for our units of activity method for this. I do want to show you one more thing though. With the example we just looked at, the truck was purchased on January 1, which if you think about it, you guys, is the first day of a calendar year. That's what made it so smooth and straight 2,400 every single year for 5 years. It was easy peasy. But I'm pretty sure you guys can understand that companies do not go out and buy up assets on the first day of the year and only on the first day of the year. So here is an example of what a company would have to do if, for example, they purchased that truck instead on April 1st. Now, you guys are hopefully figuring out in this accounting class, you got to be real careful about how you calculate your number of months. You guys do not need to say 12 months for a year minus 4 for the month of April equals 8 months of use. That is not how this works. If you bought this asset on April 1st, you were actually using it for 9 whole months. How can you determine that? Think of it this way. You didn't own it for the entire month of January, you didn't own it for the entire month of February, and you didn't own it for the entire month of March. So 12 minus those 3 months that you didn't own it means you had it for 9. What you guys can see on this chart here is that in the year of purchase, if we would have bought it on April 1st, the company could add in to an Excel spreadsheet an additional column. And what we're doing on row 1 is we're taking that $2,400 number that we've seen how to calculate by taking the depreciable cost and either dividing it by 5 or multiplying it times a rate, which is 1/5 or 20%, taking that annual amount and multiplying it times 9/12, which should be 0.75. Okay, so 2,400 times 0.75 equals 1,800 instead of the full 2,400. So for year 1, we would say depreciation expense increase 1,800, accumulated depreciation increase 1,800. You guys can see here that Wiley did not give us the book value column on this particular slide, but you guys could fill it in if you wanted to use an Excel spreadsheet and practice this problem on your own. 2018, 2019, 2020, and 2021 are all full 12-month usage. So we've used it for 9 whole months here, plus 48 months across these 4 years. So 9 months plus 48 months gets us to 57 months depreciated out. Well, that means we've got the remaining 3 months of a 1 year or 5 years total here to come up with. So this top row and this bottom row you are splitting that out, so to speak. So for the first 3 months of 2022, January, February, and March of 2022, we would have those 3 months get some depreciation calculated and spread across those income statements. So, again, just like we did on the top row, 12,000 times 0.2, or 12,000 divided by 5 equals an annual amount, but then times 3/12, or times 0.25 would give us a final journal entry of 600 to depreciation expense and an increase to the accumulated depreciation of that 600 as well, to leave us sitting at accumulated depreciation of 12,000, like we've talked about. We've spread that depreciable cost across this time frame. And then of course our salvage value would be equal to our book value if we had that one more column up here. All right, so be careful. You guys need to underline when a purchase takes place and think about how that would affect your columns and your data, and therefore your journal entries, and of course your income statement and your balance sheet. So be careful with those. Again, I will do separate videos for the others, but please use these videos, the Wiley videos and others, for making sure you get the homework and the optional review practices correct. Ask me any questions on the discussion board, and be looking for additional announcements from me about having Zoom sessions.